Hello, fellow traders. 'Tis I, the Rumpled One. To you, Monday, July the 22nd, the year 2019. Let's talk trading. Trading is easy. I said it. Oh, I bet some people seeing that name on the video probably go, oh, wait a minute. Has the Rumpled One lost his mind? Trading isn't easy. But I received an email and it said something about how to turn 25,000 into like half a million, or how I turned 25,000 to half a million. And I don't even know if it was about trading because I didn't, take the bait. But it made me think about something because, as Anthony Robbins would say, if you want a better answer, ask a better question. And a lot of people say, language is powerful, language makes your reality, etc., etc. So the thing is, I know that English is very imprecise, and when people use it imprecisely, it compounds things. So trading is easy. Now, first, let's define what trading is. I mean, if you gave somebody that didn't know anything about trading access to your trading platform, and you said, here, if you click over here on this button, you buy, and if you click on this button, you then sell, and they click it, and they wait a few minutes, and then they click to buy, and they wait a few minutes, they click to sell, and they made money, or they lost money. The question is did they just trade? Well, yes, they did. So what was so hard about that? That was easy. Now, if you do that over a long period of time, you'll probably wind up losing, just being random like that. I mentioned nothing about stop loss or taking profit. But the mere fact is that what we want to do is say we want profitable trading. And that takes time, because you need to learn how to trade profitably. And so the trading part is easy, but it's being profitable, sustaining profitability. That's what seems to be a little bit more difficult. I think you guys can agree, you traders out there, right? And so, see, because you can either win or lose, and if you're losing, it's because of one of three things. Either you don't have risk and money management in place, because even if you do have your money management in place and you take profit according to your plan, and you have your risk management in place, meaning you put your stop losses and you only lose a certain amount per trade, you could still wind up in the red. So then you have to look at your method. Does your method give you the opportunity to take profit? And if the answer is no, then you need to find a different method. But if the answer is yes, then you have to take that hard look in the mirror and look at your execution and your performance. Meaning, if your method is giving you the opportunity to make profit, yet you're not executing properly, you're missing trades, or you're rushing trades, or you're not getting in and out when your method dictates, that's on you. And so your performance suffers. And if you don't have the confidence, then you're not going to be as competent, because you're not going to learn it, because you're going to hesitate. Once again, getting back to your execution and performance, and then you're not going to be successful. So what you have to do is, if you rely on your risk management, that'll give you the confidence. So you can go in and click that mouse to enter the trade when you're supposed to and exit when you're supposed to. And then you have that, hey, success. And when you get on that success, that upward spiral, then you're going to become competent, because you're going to be doing it over and over, that repetition. Once again, money and risk management, the risk part is very simple. You can do it. Okay, let's look and see what's happening here. Euro yen, we're at 121.05 right now. And those of you tuning in on the Monday video, you can see we've already filled the gaps. And we see that on the weekly candle is looking to try and hit the previous week's midpoint. It started right there at the edge of the previous week's lower wick zone, and it shot right through it. So a weekly wick zone trade proved to be profitable so far. In fact, you're about 18, 19 pips up if you're still in that trade. And yesterday, we already filled that gap here. So price gave us a clear buy signal, and profit should have been taken somewhere around this area. At least some of the profit. Remember, traders, talking about trading is easy. You see, you don't have to go in full tilt, put all your eggs in that one trade. What you can do is you could say you want to buy 2 mini lots. Well, don't buy 2 mini lots in one trade. Have 2 1 mini lot trades. So when you get to this point, you could exit one for a profit, locking in the profit. Then maybe you let the other ride. You got in here, you move your break even up to break even +1, maybe break even +5. So you lock that profit. So if there's a big swing down, you still get a profit. Otherwise, if it doesn't swing down and just keeps going up, you get more profit. That's one way of doing it. And here, looking at the daily range here, column, there's only 2 pairs over 100. Just anemic once again. And on the daily, we're in that upper wick zone. And as you can see, when I open the trading profile, it gave one signal right here to go long, but you can see here, lower high, and it's kind of like, well, there's nothing really telling me that I should have taken that trade, because you can see here a bunch of chop, and then it moved down. So you see how then it moved up just right here, this area. So there's really no clear signal based on relative to when I entered or when I brought up the trading platform. And once again, looking at the frequency distribution of the H1 range, you see here over 20 pips, only about 7% of the time. So most of the meat is in that first 0 to 9 pips. So if you're trading and you're basing your trades off of the H1 candle color, knowing how anemic price has been, you see here, you need to take your profits somewhere between 0 and 20 pips. And some people want to know, what the heck is this high minus average and high minus max? Okay. I believe in this range gauge here, the donational from 2013, which is right here, it's showing you, since the candle's down, moving off of the high of the day, which is right there, moving down to the average. Okay, So since the average range is almost 11, 10.97, this would be the high minus 10.97. Okay, and the max range is 32, so this would be the high minus 32 pips. So you know if prices move. So right here, if you took a reversal, you can see right here it just about hit that average. So that gives you a place where you can either take profit, or if you believe price is going to continue to go up, this would be the range where you would enter a pullback. Back to simple price action. Here, 2 ball at the top, red at the line. You see the profit. Or if you're not even wanting to use, if you just want to use the simple horizontal lines and nothing more, you know based on the previous chart, the average range. And so once again, price opened between 20 and 10. It's not going to stay in there, and it didn't. Price opened between 20 10. Again, it's not going to stay in there. That's what you are, quote unquote, relying on based on statistics and simple physics and math, knowing those averages. So depending on how close price enters to the line, you know most of it's between 10 and 20, and most of it's between 0 and 10. So right here, price goes up, there's a chance it won't exit. But if it goes down, there's a chance it did. So that's how you can trade that. So right here, price open really close to the line. So if it goes up, chances are you'll make a profit. If it goes down, once again, you had a 1 ball, and you see here it entered, exited, it entered and stayed. Here it exited but came back. Here it exited and stayed. Here it exited and stayed. So you see, that's one way of taking advantage of this low volatility. You might only make a pip or two, but that's really not what you're striving for. Of course, you want to make more, and sometimes you will. But knowing the volatility, especially if you're only going to trade for an hour or two, you have to know when you take profit if you don't want to leave a trade going while you're not there. It's your choice how you trade, right? Once again, using the TRO HL5 indicator, showing the wick zones here. So here's yesterday's lower wick zone right here. See how price got in and out. And here's the high. Here's the candle top. So as you can see, we are now in that upper wick zone. Once again, simple trades. And just to show you, see right there, TRO HL5 indicator. So just using the simple horizontal lines, you too can trade profitably. But remember, these videos are for educational purposes only, and your results may differ from mine. So Forex trading, as any trading, is risky. So really be careful when you're trading, and seek your advice from an accredited professional financial professional. And once again on this, we're just looking at the swap. So if you're trading euro and yen, you really don't want to hold it overnight, either long or short, because they're just going to take some pips or some pennies out of your account. So that's it, fellow traders. Trading is easy because it's not what you trade, it's how you trade it. So go out there and drain the bank.